Investing is an important part of financial planning, and there are a number of different strategies that beginners can use to get started. One common strategy is to buy and hold stocks for the long term. This is a relatively simple and straightforward approach, and it can be a good way to build wealth over time. Another option is to invest in index funds. Index funds are baskets of stocks that track a particular market index, such as the S&P 500. This is a low-cost and diversified way to invest in the stock market, and it can be a good option for beginners who don't want to pick individual stocks. For those who want more control over their investments, there is the index and a few strategy. This involves investing in a combination of index funds and individual stocks. This can be a good way to get the diversification of index funds with the potential for higher returns from individual stocks. Finally, there is the income investing strategy. This involves investing in investments that produce regular income, such as dividends or interest. This can be a good way to generate passive income, and it can be a good option for beginners who are looking for a way to supplement their income or save for retirement. The buy and hold strategy is a classic investment strategy that involves buying a stock and holding it for the long term. This strategy is often used by beginners because it is relatively simple and straightforward, and it can be a good way to build wealth over time. The key to the buy and hold strategy is to invest in companies that you believe in and that have a strong track record. You should also be prepared to hold your investments for the long term, even through periods of market volatility. One of the benefits of the buy and hold strategy is that it can help you to avoid the temptation to sell your investments at a loss during market downturns. When the market is down, it is important to remember that this is a normal part of the investment cycle and that the market will eventually recover. By staying invested for the long term, you can ride out the ups and downs of the market and potentially earn significant returns on your investments. An index fund is a basket of stocks that tracks a particular market index, such as the S&P 500. Index funds are often used by beginners because they are a low-cost and diversified way to invest in the stock market. When you invest in an index fund, you are essentially buying a piece of the entire stock market. This means that you are not betting on the success of any one company, but rather on the overall performance of the market. Index funds are a good option for beginners because they are relatively low risk and they can help you to avoid the temptation to try to pick individual stocks. However, it is important to remember that index funds are not without risk. The stock market can go down as well as up, and there is no guarantee that you will make money by investing in an index fund. Overall, index funds can be a good way for beginners to get started with investing. They are low cost, diversified, and they can help you to avoid the temptation to try to pick individual stocks. The index and a few strategy is a hybrid investment strategy that involves investing in a combination of index funds and individual stocks. This strategy is often used by beginners who want to have more control over their investments than they would with a pure index fund strategy, but who do not want to go through the hassle of picking and managing a large number of individual stocks. With the index and a few strategy, you can start by investing in a core group of index funds that track major market indexes, such as the S&P 500 and the Nasdaq 100. These index funds will provide you with broad exposure to the stock market and will help to reduce your overall risk. Once you have established a core portfolio of index funds, you can then add a few individual stocks to your portfolio. These stocks can be companies that you are particularly interested in or that you believe have the potential to outperform the market. The index and a few strategy can be a good way to get started with investing, and it can also be a good way to gradually increase your exposure to individual stocks as you become more comfortable with the market. The income investing strategy is a strategy that involves investing in investments that produce regular income, such as dividends or interest. This strategy is often used by beginners who are looking for a way to generate passive income, or by those who are nearing retirement and need to supplement their income. There are a number of different types of income investments available, including dividend-paying stocks. These are stocks of companies that pay regular dividends to their shareholders. Dividends are typically paid quarterly, and they can provide a steady stream of income. Bonds are loans that you make to companies or governments. In return for lending them money, you receive regular interest payments. Certificates of deposit, CDs are savings accounts that offer a fixed interest rate for a specified period of time. The income investing strategy can be a good way to generate passive income and to supplement your retirement savings. However, it is important to remember that all investments come with some degree of risk, and you should always do your research before investing in any security.